it does drive profit straight to the bottom line. So the difference with Enable is we said we're going to take a cloud approach. We're going to allow people to be up and running within literally a couple of weeks. There was a real need that we were solving, and we were solving it better than anyone else could. The whole supply chain digitization piece has been so neglected that there's a massive opportunity ahead, and we're just starting out.
Welcome to another episode of The Path, a videocast and podcast series about how successful entrepreneurs navigate the world of venture capital to scale rapidly. This episode, I have the pleasure of talking to Andrew Butt, founder and CEO of Enable, a SaaS solution for rebate management driven across 50 industries globally and driving immediate impacts here as well. Andrew, welcome aboard. Tell us your journey on how you created Enable.
I had been building different types of web applications and various different kind of software solutions, and then met my co-founder Dennis Short. He had built a very successful distribution business in the UK, and it was and still does focus very much on central distribution for health, beauty, and household brands, and is the largest of its kind. So very, very successful. And we got chatting about some of the challenges in the supply chain and the lack of supply chain digitization, and specifically around the trading agreements that link manufacturers and distributors with the end customers.
As a supply chain digitizes, what's the ROI?
If you imagine, manufacturers are making things. They have factories, they're innovating, they're creating great products, and what they don't really have is lots of locations that are close to customers. And then you take a distributor, and they are typically the opposite. They're not actually making anything, but they are very close to customer. They have great market knowledge, in the markets they serve, and they know how to put products together to deliver a complete solution for the customer. So really, in many ways, the distributors are like the sales teams for the manufacturers. And what's important is to have a really joined up kind of business plan and work together to drive that growth. The currency of all of that is actually incentives and rebates. So there's a huge amount of these incentives and rebates flowing through the supply chain. Most of them are on Excel spreadsheets. This has become all of the profit margin for many, many distributors, and they're literally managing it off system. What Enable does is it automates a lot of that. It provides a very modern cloud-based approach to manage incentives and rebates and replace all these spreadsheets, and it does drive profit straight to the bottom line of again, distributors and manufacturers.
Right. So basically what it's saying is that when you've got humans involved, and we all love being human, but what's happening is that there's a chance that there may be something left on the table.
I think if we look at the original purpose of these incentives and rebates, it is to drive behaviour, and it's to say, let's say I'm a manufacturer and you are the distributor. I really want to get 100,000 of products X to market, and I want to do that in the next 3 months, and I want to target, let's say, a particular part of Australia for argument's sake, and I'm saying to you, if you can hit that target, I want to then give you an incentive, a retrospective incentive, at that point in time. And what that then means is I can achieve my volume target, and then you can get your margin. So it's a win-win situation. But what's tended to happen is, because of a lack of tooling and lack of automation, those incentives and rebates have just become deferred discounts. They don't actually have that effect. They don't drive behavior, and people don't track them correctly. They can't track them correctly, and they kind of just do what they always did, and then maybe those rebates come in, or maybe they don't. So that they really lose their power.
So that's saying that basically, you put Enable in, and then you're actually getting an immediate impact of 1 to 2% on the bottom line. Is that as simple as that?
Yeah, absolutely. I mean, when you think about it, the incentive and rebate income is often 100% of the bottom line now. It's all in that form. You've got distributors and retailers selling at cost and even selling below cost, and then relying on that rebate to kind of give them all of their profit. We have found companies are missing anything from say 1% to say even 5% of the rebates. So all of that flows straight to the bottom line. It's a really powerful ROI.
Why Enable? What's the special source behind Enable that sort of that's attracted so many customers?
there were these really modern providers where you could sign up and be using the software immediately. It was easy to use. There was possibly zero kind of setup cost or very, very low setup cost, and you could use it on a kind of month-to-month basis with low risk and low commitment. So that model was very attractive, and there was really nobody offering this type of software in that model. So the difference with Enable is we said we're going to take a cloud approach. We're going to allow people to be up and running within literally a couple of weeks, and we're going to make it very, very low risk and very easy to just get started.
Your approach to building business was very much about having patience just to build the model up first. So, you've got a lot of entrepreneurs that go, look, I've got a great idea. I think I've got it. All right, let's go out and raise money. So how do you decide when to raise money?
Well, I mean, my background was always running service companies, bootstrapping and running profitable businesses from day one, and then growing steadily. That was really how I was wired. And we had the fortune to have a thriving services business where we were building software for other people and generating some revenue. And that allowed us to then kind of create this SaaS solution, and incubate it really within our own company and reinvest the profit from our main company in building that. And then we kind of got our first couple of customers, and eventually we managed to get to the heady heights of around 10 customers. But we really could kind of prove it out and prove there was a real need that we were solving, and we were solving it better than anyone else could, and the customers were successful and happy and getting a very strong return. At that point, we wanted to start going a lot faster. We'd taken our time to get some early product market fit, and we wanted to then go as fast as we could to win market share and take the market. And that's when it made sense to start raising capital.
What's the one key learning from a region point of view when you're raising capital?
Many of the world's leading global software companies, they started and were headquartered in California. And I think the approach in the US and particularly on the West Coast is just quite different to what I saw in the UK and Europe, which is they are really looking at how to build a truly global software company. That means from a kind of financial point of view, you're looking at a high burn and a big loss in the early days. Whereas I think in other regions that I looked at, it was really about kind of investing a proportion of your revenue in those things. And if when you're very small, that equals very, very little, not very much. And we really recognized how big this market was, and how someone was going to take this market and be the first kind of native cloud solution in this space. And to do that, we would have to grow quickly and grow fast, and we'd have to invest a lot. So that kind of mentality definitely resonated much more on the West Coast in the US compared to other regions.
When you're raising funds and looking for investors, how do you find the right investor? What's important to you?
I think from an actual investor point of view, it comes down to chemistry with the actual kind of investor themselves, the person who probably will join the board of your company. I think I heard one VC tell me that relationships with investors, sadly, maybe last a lot longer than the average marriage. So that these decisions are long term, and you're probably going to be working with the VCs and investors for, say, 5, 10 or more years. In terms of the firm or the fund, that's of secondary importance to the individual. But I was looking for firms that were not sort of so massive that we would just be a tiny rounding error and they wouldn't really care, but equally big enough to have that depth and that depth of network, because getting to and through IPO is an expensive process.
What's next for Enable? What's the uncharted territories, I guess?
The market is just so huge, and at the end of the day, yeah, we've come a long way. And to give you an idea, we had about 100 people a year ago. We're now at well over 200. We'll be nicely over 300 this year. We'll be at 1,000 within 3 years. So that gives you a sense of scale. We've got a few core industries where we have some real dominance, and then we have quite a few others where we've got the odd customer here or there, and also of course geographies. We started in the UK, and 2 years ago we had nobody in North America at all. And now we have over 100 people in North America, and of course Australia is an exciting market for us. We are just right at the beginning here, and expanding into new industries, new verticals, new geographies iterating and improving our product, and then adding adjacent products as well. But I just think the whole supply chain digitization piece has been so neglected that there's a massive opportunity ahead, and we're just starting out.
Andrew, once again, thanks so much for sharing the journey and vision. And for everyone else, I hope you enjoyed the chat, and please feel free to share and subscribe, and see you next time.